LoanX is about loan receivables, and we've broken down the product into 4 simple steps. Step 1, which we are all very aware of, NBFCs, and we've mentioned 2 here, the ones that we work with currently, Keertana and Vedika, but these could be NBFCs that you may have come across, including, say, an Incred, a Clicks Capital, or even a Navi FinServe, right? NBFCs like this, on a regular basis, give out loans. These are to individual businesses, groups of individuals, and against these loans, they expect a monthly return of principal and interest payments. We have all been on this side of it. We've probably all taken some or the other loan in our life, and a bank or an NBFC has given that loan to us. What happens very commonly, and something that accounts for $20 billion of transactions, is such loans are assigned to a trust. And the payments that are coming from these loans are also assigned to the trust. So the NBFC, as a way of raising money, assigns its existing loan book to a trust. It continues to meet the obligation of servicing these loans and working with the borrowers to ensure timely payouts. What GRIP has done is to work with these NBFCs to now convert this into a product for retail investors. One of the big steps there is to add a layer of security. Not only is an investor getting the fixed monthly returns, but the NBFC puts significant skin in the game, takes significant exposure, or continues to take significant exposure by putting a fixed deposit in the form of a cash collateral, providing over collateralization, and an excess interest spread. And we'll explain these terms to you during the course of this conversation. We've been able to convert or have the trust issue SDI units to investors such as those on this call and be able to participate directly into this pool of loans, but with the additional advantage of the security cover and the servicer and the originator still being the NBFC. LoanX, hence, is the securitization of these loan receivables through a SEBI-regulated trust directly into your demat account.
First LoanX opportunity which we launched was with Keertana NBFC, as Weber mentioned. So that was is a A- rated transaction which is available for our investors with a deal tenure of 17 months. Total deal size is 20 crores, and the returns which are being offered to investors is 13.5% IRR, which turns out to be a multiple of 1.1x. This opportunity, wherein the underlying loans of Keertana are securitized for investors, entail monthly cash flows to investors in form of principal and interest, and the underlying pool consists of around 2,500 borrowers. So it's a very granular pool comprising 2,500 individual borrowers with different business, uh, different nature of businesses of these borrowers, right? So in other words, no single borrower constitute more than 0.1% of the overall pool. So it's amply diversified. Along with these features, there is a security package available in the transaction. So the three components of security package are: one, there's an over collateralization of around 11%. So over collateralization means that there is a additional loan cover in the transaction. In other words, the total loans assigned in favor of the trust or the pass-through entity, say for an example, is rupees 100 or 100 CR for an example, right? Out of which the total pool subscribed by the investor will be 90 CR. So the cash flows which will be available to the investors would be pertaining to the overall pool. So there's a buffer cash flows available for our investors, and trust can dip into the cash flows from their buffer pool of 10% in our example, and in this case that buffer pool is 11%. It provides additional liquidity for the trust to manage any exigencies or any delays in cash flow. So apart from over collateralization, the second very key aspect of security package is cash collateral. So cash collateral is simply an upfront liquidity. It's a FD which is available with the trust, which is in tune of 5% in this case, and trust can straight away dip into this cash collateral to pay investors if the regular monthly cash flows are impacted due to any circumstance, right? So these two instruments are these two, apart from these two security components, the third component is excess interest spread. I know we have spoken about it in the last webinar also. So excess interest spread in this transaction is around 16%, 15.5% to be specific. And this actually means that the underlying loans have a additional cash flow stream in form of excess interest, which is available. For example, the underlying loans have a certain coupon, and there's a gap in the coupon which is being offered to investors. So therefore, this excess cash flow stream, which is in form of excess interest, is also available with the trust, and this can be utilized by the trust to pay investors as equivalent to the other security components. So this was some key features about our last or which is still live on our platform, the first LoanX opportunity which we launched with Keertana.
Maybe just to add to Rishabh's point, what really excites us as a team about this product is the point around diversification and security, right? And then anything on the tenure and the returns can obviously be linked to that. But for an investment of say 1 lakh rupees, the number of borrowers or number of loans in this instrument are 2,500, which means every loan is only given 40 rupees of your investment. In addition, the first 17%, first 16%, which I'm calculating by saying over collateralization of 11% and cash collateral of 5%, so 16%. The first 16% of the loss is effectively borne by the NBFC, that is Keertana. Over and above that, if there is some gap in the interest, there is a 15.5% EIS spread or excess interest spread that protects returns. The combination of diversification and these security measures, in our view, really impacts the quality of this pool, which is why a rating agency like CRISIL assigned it an A- rating, which is an investment grade rating. And against that, the returns we're able to offer in this transaction are 13.5% IRR.
Second LoanX opportunity is with an NBFC called Vedika. Vedika is quite a established name in the industry, right? So this opportunity is rated A by Care and is with a tenure of 19 months. The total deal size which is available for our investors is 14.5 CR and comes with a pre-tax IRR of 12.7%, which turns out to be a 1.1% multiple, right? And similar to the last previous LoanX opportunity, this also consists of monthly cash flows which will flow to investors uh, in form of principal and interest, right? And the underlying pool is in fact even more granular in this case. It comprises of 4,000 individual borrowers. These are retail borrowers, and therefore provides diversification in the pool. And now, yeah, if we talk about security package, similar to the previous one, the similar three components, but the quantum or the magnitude is different in this one. It has a cumulative cash collateral and over collateralization constitute 22% of the pool, right? This is the maximum upfront liquidity in form of cash collateral and over collateralization which such a transaction can have, right? So over collateralization is 10%, which again is a buffer loan pool, buffer loans which are available in the transaction. Again, the trust would have access to the cash flows from these incremental loans, and cash collateral is again 12%, which is upfront liquidity, upfront FD available with the trust to dip into, and EIS is 13.8% in this transaction. So I think there are a couple of questions on EIS as well in the Q&A box, right? So I will again talk about it just to briefly describe what EIS is, right? So for an example, the underlying pool has a weighted average interest component of say 15%. Just an example, right? So the cash flows from this 15% coupon will flow to trust first, right? And if the coupon which is available for the investors as part of the transaction is say 10%. So since the cash flow is a higher stream, particularly for interest, right? So these additional cash flows would first flow through trust. The cash flows for that would come in trust's bank account, and therefore these incremental cash flows will be available with the trust and can be utilized to pay investors if the regular cash flows are impacted. So therefore, this excess interest stream is available with the trust to utilize uh, in these kind of transactions, which is termed as excess interest spread. It is 14% in this transaction. So yeah, better yeah, around 22% upfront liquidity and excess interest rate of 14%. This is again a very granular pool of 4,000 retail borrowers, and yeah, so that's some key features of the transaction. Nikhil, Weber, if you want to add anything.
No, just let's just move forward, and maybe if we can talk a little bit about
Sure.
about the specifications of the pool itself.
Yeah, definitely. So this underlying pool is a JLG loan pool. JLG essentially means joint liability group loans. It's a very significant portion of NBFC's market in India, and JLG loans means that people collectively with same kind of businesses take loans from an NBFC. So these kind of JLG loans are pooled in the transaction. And in order to mitigate some of the inherent risk of this transaction, what we have done is, say if there's a group of four people who have taken loan from an NBFC, we have deliberately not included all four people in this pool. We have very selectively only included one of those borrower of from that JLG pool in our transaction. So therefore, this is fairly diversified despite of being a JLG loan pool, right, of 4,000 retail borrowers. And if you see, the ticket size is quite smaller. Around 45% of the borrowers are in the range of with a ticket size of 36 to 45,000, and then in the 46 to 60,000 ticket size, then the remaining 39% of the borrowers are there. So therefore, it's a fairly diversified pool with a smaller ticket size. And if you look at the geography wise exposure, this is again diversified amongst total in 7 states, out of which you can see on screen the exposure in top 3 states. Yeah, similarly, the purpose for which these people take loans is again further diversified. Some people took this for business purpose, some for agri-allied purposes, and this Vedika is also focused on female lending. So therefore, you would see a slightly higher portion of mix towards female borrowers. 96% of the borrowers are female in this, but that's after. So we in our discussion also with Vedika, they also, based on their research also, they which clearly indicates that female borrowers are better borrowers in terms of servicing the pool, and the rates of delinquencies are also are lower as compared to male borrowers, based on industry research as well. Yeah. So that's how the pool is diversified based on ticket size, geography, and the nature of loans.
Yeah. I would just like to add that apart from this diversification, RBI, which regulates NBFCs, also puts in place certain minimum criteria for what the pool should consist of. For example, one of the criterias is that the loans must be at least 3 to 6 months old and should not have had any delays in payment. There should be no defaults. And that is a mandatory criteria from RBI for all such transactions. So in addition to the selection that is being done here in terms of achieving diversification, as an investor, you're also getting the benefit of certain RBI rules for securitization of such loan pools. Rishabh, back to you to maybe talk a little bit about also the return structure.
Yeah, and Rishabh, if you could also just touch upon the taxation part of the instrument, that'll be good.
Sorry, I was speaking on mute. Yeah, sure. So first to talk about taxation first. The cash flows which will flow to investors every month will be split into principal and interest, right? As these are in any PTC or STI transaction, right? So the only interest component is taxable in hands of investor, and trust will also deduct a TDS, which will vary from 25 to 30% based on kind of investors who are holding this instrument. But only the interest component will be taxable in the hands of investors based on their marginal tax rates, and this will be classified as part of other sources. But we definitely advise you to also take consultation from your tax advisors if you want further granular information on the tax aspects. So now, talking about the repayment structure. So this is a 19 months tenure deal, and with a fairly equated monthly cash flows. And if you would see, if we consider the upfront cash, collateral, and liquidity available with the transaction, the investors will be completely covered after 12 months. So considering the regular cash flows and the available liquidity, if you invest in this transaction, you will be fully covered once after the cash flows of 12th month. And if we do not take into account cash collateral or the security package available, the money would be you will be covered in 17 months if we only consider the cash flows, right? And if you look at monthly cash flows, every month you will be repaid somewhere to the tune of 5 to 6%, which is also visible in the third or fourth column with the heading total repayment, right? So in a 1.1 multiple, the cash flows are split in this fashion, wherein 5 to 6% is getting repaid every month. And as the pool amortizes, as the cash flows, as the principal outstanding goes down, you would clearly see that the upfront liquidity as a percentage to outstanding principal keeps on increasing. Therefore, in the last column, it's clearly visible that the OC and CC, which provides upfront liquidity, was 22% in the first month. And as the principal amortizes with the monthly repayments to investors, this keeps on increasing. And if you look at 13th month, it will be 50% of the outstanding principal, which is a very significant number to look at from a safety perspective. So that's how your cash flows or your returns will be structured during the course of these 19 months. And yeah, uh, that's how your cash flows will be distributed.
Yeah, thanks, Rishabh. Quickly, just wrapping this up. So, fairly homogenized amortizing structure of principal and interest. The couple of landmarks are at 12 months, your 100% of your capital is de-risked, and the payback period fully is between 16 to 17 months. And the last point is that the security cover keeps on increasing as percentage of your principal invested as you go along the tenure of the instrument. If we can, Rishabh, if you can just also talk about the key risks and mitigants for investors in a structure like this.
Yeah, yeah, definitely. So two key risks which are there in this transaction are repayment of interest or loans in this transaction, right? Which is somehow mitigated because the underlying pool is diversified, and as we discussed earlier, the ticket size is also very small, right? In between 35,000 to 60,000, majority of the pool is of that ticket size. But yeah, there are 4,000 plus borrowers in the underlying pool, and supposedly if you invest 1 lakh in this transaction, your average exposure to one loan will be only 25 rupees, right? So therefore, that risk of repayment of underlying loans is covered by the diversification available in the transaction. And if you look at if we talk about the repayment of loan only, then also due to the security package available, there is a liquidity of 22% of the loans, 22% of the outstanding principal which is available in the transaction. So if any circumstances happen or due to any exigency that there are defaults or delays, you are covered to the tune of 22% of the loans. And due to excess interest spread which is available, your interest repayments are also covered to the tune of 56%. If the overall interest repayments are impacted to up to 56%, your cash flows will not be impacted in any manner due to the due to the additional liquidity available because of excess interest spread. So this is how the security package which we spoke about would play out and would cover the investors in case of any circumstances which are not favorable.